Investing is widely considered the most effective way to accumulate wealth. By diverting resources away from current consumption, individuals can harness the power of their assets to generate returns in the future. But what happens to these investments when the economy enters a recession? How do market dynamics shift, and what can investors do to protect their portfolios during these challenging times? In this article, we will explore the impact of recessions on investments, focusing on different asset classes, strategies for minimizing risks, and the importance of long-term financial planning. Whether you are a seasoned investor or someone just beginning to think about their investment strategy, understanding the effects of a recession on your portfolio can help you make informed decisions. The economic impact of a recession. A recession is typically defined as a period of economic decline that lasts for at least 2 consecutive quarters. During a recession, economic activity slows, businesses cut back on investments, unemployment rises, and consumer spending falls. Recessions are cyclical and can be triggered by various factors such as inflation, financial crises, or a global economic slowdown. The broader economic conditions of a recession directly impact the performance of investments. Stock prices may fall, interest rates may be cut to stimulate growth, and consumer confidence may plummet. In these times, many investors experience increased anxiety about their portfolios, wondering how their investments will hold up against the economic downturn. While recessions can bring volatility and negative returns in the short term, they can also present opportunities for those with the right strategies in place. Understanding how various investment assets are affected during a recession is the first step towards positioning your portfolio to ride out the storm. Stock market performance in a recession. The stock market is one of the most commonly impacted investment vehicles during a recession. As consumer spending contracts, companies may see their profits shrink, leading to declines in stock prices. Market volatility increases as investors attempt to navigate the uncertainty caused by an economic slowdown. However, not all stocks are equally affected. Some sectors, such as technology and consumer staples, may be more resilient to recessions, as demand for certain products and services remains relatively stable. On the other hand, cyclical stocks, those that depend on a thriving economy, such as luxury goods or travel companies, often suffer the most during a downturn. A recession can be a time when strong, established companies with solid balance sheets become undervalued. For long-term investors, a recession may present an opportunity to buy quality stocks at a discount, positioning their portfolios for strong growth when the economy recovers. Bonds, a safe haven or a risky bet? Bonds are often considered a safer investment compared to stocks, particularly during times of market turbulence. When the economy contracts, interest rates tend to fall, and bond prices typically rise. This inverse relationship between interest rates and bond prices makes bonds an attractive option for conservative investors seeking stability during a recession. However, the safety of bonds depends on the type of bond and the creditworthiness of the issuer. Government bonds, especially those issued by stable economies, are generally considered low-risk investments. Corporate bonds, on the other hand, carry more risk, as the issuing companies may face financial difficulties during a recession. While bonds can provide a source of steady income through interest payments, investors should carefully assess the credit risk associated with corporate bonds. High-yield or junk bonds may offer attractive returns, but they are also more susceptible to default if companies face financial challenges during a recession. Real estate investments, a double-edged sword. Real estate is another popular investment avenue, but its performance during a recession can be quite mixed. On the one hand, real estate investments often offer stability and long-term capital appreciation. On the other hand, recessions can lead to a decrease in property values, particularly in areas that rely heavily on economic growth and consumer spending. The impact of a recession on real estate depends on factors such as interest rates, housing demand, and regional economic conditions. When interest rates are cut to stimulate economic growth, mortgage rates may also decrease, making real estate more accessible for buyers. However, during deep recessions, property prices can decline due to reduced demand and higher unemployment rates. Investors in real estate may also face challenges with rental income. If tenants lose their jobs or face financial hardship, landlords may experience increased vacancy rates and difficulty collecting rent. To protect against these risks, real estate investors can diversify their portfolios by investing in different types of properties or focusing on more recession-resistant markets, such as those driven by healthcare or government services. The role of diversification in protecting your investments. One of the most effective strategies for mitigating the risks of a recession is diversification. By spreading investments across various asset classes, stocks, bonds, real estate, commodities, and more, investors can reduce the impact of poor performance in any single investment. Diversification helps to buffer against the volatility often associated with recessions, as some assets may perform well when others are struggling. For example, while stocks may decline in value during a recession, bonds or precious metals may increase in value. A well-balanced portfolio can provide a more stable return over time and protect investors from significant losses. It's essential to ensure that diversification is aligned with your financial goals, risk tolerance, and time horizon. Investors with a long-term perspective may be able to weather the storm of a recession, as they can take advantage of buying opportunities that arise during market downturns. Strategies for managing your portfolio during a recession. During a recession, investors should consider adopting strategies that help preserve capital and reduce risk. Here are a few strategies to consider. 1. Rebalance your portfolio. Regularly review your portfolio to ensure that your asset allocation aligns with your investment goals and risk tolerance. If stocks have declined significantly during a recession, it may be a good time to shift some of your portfolio into more stable investments, such as bonds or dividend-paying stocks. Look for companies with a strong history of paying dividends and stable financials. Invest in defensive sectors. Some sectors, such as healthcare, consumer staples, and utilities, tend to perform better during a recession. These sectors provide essential goods and services that are in demand regardless of economic conditions. Increase cash reserves. Having a cash reserve can provide flexibility during a recession. This reserve can help cover living expenses, provide liquidity for opportunities, and give you peace of mind during times of uncertainty. The importance of long-term planning. While recessions can cause short-term disruptions in the market, it's important to remember that investing is a long-term game. History has shown that markets tend to recover after economic downturns, and those who stay invested and maintain a long-term perspective are often rewarded with strong returns. It's essential to have a plan in place that takes into account both the good times and bad times. This includes having an emergency fund, diversifying your investments, and regularly reviewing your financial goals. By focusing on the long term, you can make better decisions during a recession and avoid panic selling or making rash investment choices. Navigating the recession with confidence. Recessions can be difficult for investors, but they also present opportunities for those with the right strategies. By understanding the impact of recessions on different asset classes, diversifying your investments, and maintaining a long-term perspective, you can weather the storm and position your portfolio for growth when the economy recovers. Remember that investing is not about short-term gains, but about building wealth over time. By staying calm, sticking to your strategy, and adjusting your portfolio as needed, you can navigate the challenges of a recession and emerge stronger on the other side.